Adjustable rate mortgages. They are seeing high demand after years of little interest from borrowers.
Unlike fixed rate mortgages, interest rates for these home loans adjust over time, as you can imagine, based on the market. The Mortgage Bankers Association says adjustable rate mortgages made up more than 11% of applications in the first week of October. That's up from around 3% from the start of this year.
Joining us now is Aarthi Swaminathan. She's a real estate reporter for MarketWatch. Aarthi, thank you for joining us. Okay, so mortgage rates going up, applications going down in general. Why is this one area of adjustable rate mortgages? Why is interest on the rise there? And I mean interest, not the interest rate, but people's interest.
No, for sure. So mortgage rates, to set the stage, they're the highest level in 20 years. Rates have not been this high since 2002. So the reason why the adjustable rate or ARMs are so popular is that they are a full percentage point lower than the 30-year fixed rate, which is by far the most popular product. But as you noted, that's really increasing from 3% to 12%. So a lot of people are thinking, why are we paying hundreds of extra dollars to the 30-year mortgage? We should just take advantage of the lower rate. So if you're really financially strapped, it might make sense for you to take an ARM in the short term, given that it is still a fixed rate for the first 5, 7, or 10 years, depending on what you sign up for.
Now, going back to interest rates 101, how does inflation and the consumer price index impact the adjustable mortgage rates or adjustable rate mortgages?
Right. So inflation directly does not impact the way these mortgages work. It's actually through the Federal Reserve and how they impact interest rates, which then affects the 10-year Treasury, which then, it's a long story, but that's how it really affects the adjustable rate and the fixed rate product. The adjustable rate product is something that, again, is not something that is very popular, but it is, of course, responding to all of these changes, a lot of these demands. So it is going up. So it seems like it is going to continue going up because of the fact that it is still far lower. But then again, it is sort of a risky bet given its interesting history from the last recession.
Trust in the future.
Yeah. Okay, so bottom line then, who are these adjustable rate mortgages, ARM mortgages, ARM as you call them, who are they suitable for?
So I always think of it as an arm and a leg. It's just, it kind of bites you in the back, right? If you don't have enough of a financial buffer, this is not for you. So if you take an arm for 5 years, it ends up expiring basically after 6 years. It goes into the variable rate. That's going to be a really big shock to your system. So you shouldn't do that if you're not financially ready, or if you don't, your income is going to go up. But if you are thinking of selling your home in 5 years, in 7 years, before that fixed rate expires, you should really consider it. But again, you should really do your research, because the last time adjustable rate mortgages, they really took off, they went up to 35% of applications. That was during the last recession. So it is a very smart bet if you're financially savvy and you think your income is going to go up. And if you think you can get out before the term expires. Someone on the weekend told me that their arm just expired. It's just 6. And they're like, oh my God, now my rates are at 7%, and they own a house in New York. So don't put yourself in that situation if you can. So yeah, just make sure you're doing your homework.
Aarthi, I love this advice. Consider an ARM, an adjustable rate mortgage, but be careful because it could cost you a leg.
Precisely. That's it.
Okay.
I saw that coming. Aarthi, thank you so much for all that wisdom. We'll make sure not to be too optimistic.
That's great.
Thank you so much, guys.